digitaljamsessions.com.
Hello and welcome to this Digital Jam session. Today we're joined by David from Edge Investments and Stuart from Crowdcube, and we also have with us Ada from Level39. Hello guys.
Hi.
Welcome. So first of all, I'm going to ask you all to explain exactly who you are and what it is you do in the organisations that you work with. And I'm going to start with you, David.
Hi, I'm David Fisher. I'm Investment Director at Edge. Edge is a creative industries venture capital company. We invest in companies that create, distribute, monetize content and the technologies that enable the creation, transportation, digitization and monetization of that content.
Wonderful. Not to be confused with Edge, the magazine. And Stuart, why don't you tell us a little bit more about what you do at Crowdcube?
Sure. Stuart Nicol, I'm the growth director of Crowdcube. Primarily, we run some small investment funds, one for London Co-Investment Fund, which I look after. On the platform, Crowdcube itself is the leading equity investment crowdfunding platform. And through that, we invest in businesses across all sectors and stages, but we've done a fair amount in media as well.
Wonderful. And Ada, why don't you explain to us all about what Level39 is and what you do?
Right, so my name's Adiza Tijani and I'm Head of Ecosystem Development at Level39. Level39 is a technology hub based in Canary Wharf, and we currently house 194 companies that range from a really early stage to Series C. We have a great mix, and I also run our investor relations program, which has brought over 120 hours of investors to our companies here at Level39.
Gosh, that's an awful lot of companies.
Very busy.
Very busy indeed. So first of all, what I wanted to get into today was this conversation around the emergence of all these different types of funding that have become available for new startups. And the reason that I'm going to throw this first of all at you, Stuart, is because things like crowdfunding and equity investment have become quite the PR thing to do these days. And I'm curious from your perspective, what you think has really caused the emergence of that type of funding, or why there is kind of a bit of a love affair at the moment with this very popular form of crowdfunding and equity funding.
Sure. Well, I think, we started just about 5 years ago when the two founders were really keen to raise some money for another venture and just really didn't like the old-fashioned way of paying to pitch to business angel networks, never being sure about what the response might be. The rather inefficient routes of speaking to venture capital and, again, not knowing how fast that response might be, and just the inability to galvanize all the people who really believed in them in an efficient manner. And I think that's really what one of the main things equity crowdfunding does, both from your friends and family and people you've maybe worked with in the past to people who have begun to see your product or want to see your product happen and are prepared to support you in that.
Okay, so I'm curious from your perspective at Level39 that there's a bit of a diversity there in terms of the types of stage which those startups are at and what kind of funding they're at as well. You mentioned there about Series C. And I'm curious from your perspective, what kind of percentage of these businesses you're seeing wanting to use something like crowdfunding or equity funding in order to get the traction that they're looking for?
So because our businesses are really sector focused, so fintech, future cities, retail tech, it means it really does. I think you should really be careful in how you pick your investor. For some things, crowdfunding works, and for other things, it doesn't. So for the companies making their choices, they have to be really careful on whether or not the benefits are there with the investor or the investment type that they choose. So we try to stay very neutral. So we had seeders, the Crowdcubes come in, but I think that there needs to be more education of entrepreneurs on how to actually go about your fundraising journey. Different types of fundraising work for different types of companies. And it shouldn't only be when you're reaching your limit of your burn rate that you should be thinking about fundraising. And some people see crowdfunding as a really quick win, but actually it does take as much effort to actually rally the crowd to give you the money in the first place. It doesn't happen overnight.
Indeed, it's one of the common misconceptions and myths around crowdfunding is that it is about driving an audience and creating an audience. But in actual fact, the reality is that if you don't have that audience before you hit the crowdfunding platform of choice, you're not likely to acquire it through the platform itself. And I don't know whether or not you found that to be the case, Stuart.
Yeah, I'd agree with pretty much everything you both said. But, you're just making it that much harder if you don't have that audience lined up beforehand, or the really commitments of a decent proportion of the money beforehand. Doesn't mean it can't happen, but it's hard enough raising funds. You should pre-prepare, and as Adia was saying, get everything well organized, take your time over the crowdfunding to make sure it really works well.
And I think from my perspective, one of the things that I really wanted to kind of get to today was to explore other alternative routes that aren't necessarily quite so popularized at the moment, but are actually the more traditional routes, if you like, which is why I come to you, David, and your new fund. So I'm very aware that you have this new fund, but why don't you explain more about actually the process and the approach that you take in general?
I will do. Just one comment on the prior conversation, if I may.
Sure.
I think it is right that it's horses for courses. I think some of the comments made were right. What Edge thinks is that by being a specialist, we bring considerably more than just money. We have a network of people that we built up over years, if not decades, in and around the creative industries and in and around the technology world, where we can bring that network to bear, whether it's new chairman, contacts, taking them into companies they want to do business with, whatever it might be. So one of the things we've also seen with early stage businesses is it's a journey, and series seed, A, B, C, whatever it might be. I think you need a funder who can stay with you through that journey, trying to chop and change from a seed investor to an A to a B, maybe C or pre-IPO is a different world. But I've been in venture for 15 years, and I've seen companies need hand-holding for many, many rounds and many years before they get it right and come good.
I agree with you on the actual side of the long-term perspective, because the only reason we introduced investor relations education to our companies was to help those relationships start early on, because you shouldn't just be going to your investor when you need money. It's a long-term relationship, and investors now need to bring more to the table than just money.
Indeed.
Yeah, I agree. And I think, so we've got our new fund, £40 million fund, and it's cornerstone by the British Business Bank, which I know Stuart knows, for example. They are an arm of government that cornerstone venture capital funds, because raising venture funds is difficult because of the returns have proven patchy. So we then raised capital from other private investors, high net worth individuals, family offices and the like, most of whom are putting money in because they want to do more with us than just have us manage their money. They want to come in on co-investment opportunities, get involved, take board seats and help grow the companies. So we're very excited about this. As you can imagine, it's a 40 million fund that we're going to invest in the next probably 3 years in somewhere between 12 and 15 companies, all in the creative industries, whether that's in content, making kids shows, making television shows, catalogues of music, film, television, whatever it might be, but also in earlier stage tech businesses that, as I said before, generate, monetize or distribute the other sort of content. So that's what the fund is about, to answer your direct question to me.
But I think it's probably worth clarifying for those of our listeners who are suddenly thinking, "Ooh, 40 million, I've got to get in there," that this is not about funding individual projects, films or TV shows or very specific granular detailed projects, but this is really about focusing on technology or the platforms and ways to innovate.
Well, it's about investing in companies.
Yes.
Companies that do have projects, companies that do want to complete a television commission. So we've got an investment, for example, in a company called By that makes kids shows. It's brought the clangers back to the UK television, and we are investors in the company, By the company, that owns the rights to the clangers and gets it financed in various ways in partnership with the BBC, PBS, and some money from us. So, yeah, very much not projects. Projects are too risky, one-off. We invest in businesses, and great businesses we can grow and help to grow.
Wonderful. Just making sure that we've clarified. So I have a generalistic question, and I'm opening the floor to who thinks they are best placed to answer this question. But one of the things that I find to be quite common amongst a lot of the startups that I mentor with at places like Oxygen Accelerator or going to various other different incubators or places that I go to, the one common trend that I see is that there's a lot of new startups who assume that when you say fundraising, it means equity. And there are very few businesses who understand the concept of things like debt financing. And is that something, for example, Adia, that you have experienced at Level 39? Has anybody ever tried going with something like debt finance?
So what we've done is we've actually helped our entrepreneurs understand what that means. So we brought in Silicon Valley Bank to actually explain what does it mean to raise capital using debt financing. And I think that that's one of the hardest things for entrepreneurs. Yes, there is a lot of stuff online, but being able to have someone there who can explain to you the intricacies of the different funding mechanisms is really important. And it's the same with people like the London Stock Exchange who have come in to do a seminar for our companies. And they, even though our companies are not listing right now, but their mindset that you need to actually know what it means to list is important to have early on. But I think that the investment industry is doing a lot to help entrepreneurs understand how to navigate. But we always welcome more investors that are happy to help encourage and also understand the dynamics of the investment space, because it's fast changing. Even the investment space is also being disrupted as well. People see funding as a form of disruption into the investment space as well. Education is key.
And is that something that Crowdcube spend a great deal of time doing, Stuart, in terms of educating the community?
We try to, but I think most people educate themselves via Q&A on the website with the company. And a lot of the entrepreneurs, if they decided to go with us, they've already chosen their equity path. We are beginning, we've funded more than 320 businesses now. So we're beginning to set up a funded club. We set up a funded club. We had an event last night whereby we're hoping to introduce them to people like Smith & Williamson and KPMG so they can sort of better educate them on that journey. But really, for most businesses, especially if you're not making any sales, then debt's really not appropriate at this stage.
Absolutely. And that's, I think, part of the education process that I think we're talking about is that understanding different types of finance and when it's right for those different types of finance is quite important, because a lot of these new startups and a lot of these entrepreneurs are going through an educational process that is formulated by going to an accelerator or going to an incubator, where actually they are having a very intense period of learning that is very much focused around equity finance versus necessarily any other types of finance. So they're not necessarily learning any other ways to raise funds for their business. And I'm curious from your perspective, David, when you see a lot of these new startups coming to you, are you finding that there is any particular gaps in knowledge that you're finding or any particular bias that you're finding with them?
I think the 2 points to make in terms of debt, it's already been said. These early stage businesses are not going to get debt from many traditional sources that I know of. Obviously, there's some new models out there like Funding Circle that are doing very well, but I think they're still looking for fundamentals of revenue and profitability. And I'm glad Silicon Valley Bank was mentioned, I did have an investment with SVB where they provided a thing called venture debt, which seems to go in and out of fashion. I don't know if it's in fashion now or not. But
I'm sure by the end of the podcast it will
venture round goes in and out of fashion. Basically, if you raise venture capital from organizations which the banks, whoever's doing it at the time, believe are the right ones and it's the right size of round, they will come alongside with what they call venture debt, which is debt. It needs repaying, but it finances the business without dilution to the other shareholders, whether it's founders or the VCs. So one of the things we do see from any business, probably ever, but again, it goes in cycles, is a degree of naivety on pricing. And I would say that being a buyer rather than a seller, but in terms of the belief in the value of a business which is still very early stage. We tend not to do seed or startup. It's very rare for us to do anything like that because of the risk profile. But even after that, you get £1 of revenue, they multiply the value of that by anywhere between 10 and 100, and that's your value, which puts off certain investors. Maybe you can find that funding from others, but I think institutions are balking at some of the prices that seem to come out because, of course, they're all going to be the next Google.
Yes, in an ideal world, that is the ambition. But I'm curious because I'm very aware that a lot of our listeners are going to be thinking, I have no idea where to start. Where do I start when it comes to finding finance for my new startup? I've just had a genius idea, a genius business that I want to put together. Who do I go to? What do I do? How do I start? So my question to each of you would be this. What would be the first thing that you would advise somebody who is going to create their new startup for the first time in this process, looking for finance, looking for fundraising? What would be the piece of advice that you would give to them? And I'm going to start with you, Stuart.
Yeah, I'd always, my general answer to all these things is to ask a friend who's hopefully done it before, who knows somebody who's done it before. So that's sort of the science and art of networking, is the top skill to be gathered at that stage. And there's no such thing as a stupid question. So just keep asking questions. And then through that, you'll discover various events which can go on to explain this. Or most people who have a loose acquaintance with somebody, you know, if they're an accountant, they'll sit you down for 20 minutes or something like that and explain it to you. There's loads of books online. I'd rather normally do it face to face myself.
What about you, Adiza?
So I would say that I'd agree that it's so important to either see if you can find another experienced entrepreneur in the field who can actually give you both sides the story so that they can explain their journey, but also they can help you open up networks and how to navigate the investor landscape, because they have done it before and leveraging that is important. I'd say that in London right now, a number of different funders are doing a lot more to outreach. So keep a good eye on the top level VCs. But there are so many VCs as well and angel groups that are a bit more off the radar. So using things like LinkedIn and Twitter to actually do more research, using your network to outreach, as well as trying to hear from experienced entrepreneurs as well. My two key things that I'd say. Okay. Sorry, I did two rather than one.
It's all good. It's all good. And David, what about you? What would be your advice?
To be slightly contentious or flippant is don't. Don't try and get finance for your business as a startup. It's bloody hard. No, but the best way to finance the early stages of a business is things called customers. Find something that can generate income. Use that income to grow the business you do want to grow to a position where you are in control and you can find, as has been said, someone who's done it before, friends, family, someone who can put money into your business at a very early stage through SEIS or EIS funding. And then when you're at a stage where you're attractive, suddenly the world opens up. You've got the crowdfunding, you've got the earlier stage VCs, the angel networks. It's all there. But I just think going with an idea is, how can someone really back that? It's very difficult. Going with something you've actually built to a stage where people can get their hands around it, around the product and around the revenues, your customers. We look for some businesses that have something that they've sold to someone they're not related to for some money.
Not related to, I like that.
And in that way, you can check out the business. You understand what it does, how it prices, who pays them, what their margins are. So, but back to my opening comment, not that they shouldn't, but they should know when to go out to try and raise equity finance. Okay,
so I have a question then, based on what you've just said there, which is, do you think then that there is a bit of a kind of a pattern of emergence and a trend, if you like, of people who are springing up these businesses where actually it isn't really based on a tangible asset of any sort? It's a hope, a dream, and it's a vision that people believe others will believe in their vision and they want to sell that vision. Do you think there's a lot of those businesses that are popping up where there isn't anything really tangible there? I mean, do we think that is a symptom of things like Silicon Valley and the Facebooks of this world and all of those very tech software, digi setups where actually there really isn't anything necessarily tangible there to sell? Do you think that is a bit of a trend that's emerged?
Yeah, I don't think so. I mean, I think that if it is a non-tangible idea that eventually doesn't have people using it to generate either multi-million users or multi-million revenue, then it won't exist. And if someone has a belief and a dream, that's what generates new businesses. And that's what entrepreneurialism is about, and is not listening to people who say words like don't. It's just getting on with it and making it happen and eventually finding someone who believes in them and wants to back them. And in creative industries, we see people who have beliefs and dreams and ideas and concepts, which probably are more amorphous than some of the tech things. You mentioned software. No, you need to write lines of code for software, but you don't if you draw a picture and you think this could be a cartoon character that the BBC should finance a 52-episode production. So, no, but it's about when you go out to those sources of finance with your idea and ignore people who say the word don't.
So I agree fully. I think that the naysayers and those that say, oh, don't do it, are sometimes scared themselves of doing it. But I think the other important thing to realize is it is hard. Being an entrepreneur is a really hard thing, but it's a thing that is possible if you believe in your product, you have a great team, the right investors, and you do have to sell something at some point. A lot of people forget that.
Yes.
And that actually, it is important, but you do need to have some inspiration, idea to actually capitalize on to make that product.
Yes.
And some people don't have that. And I think that there is a lifestyle issue within the entrepreneurial scene. Being an entrepreneur is a lifestyle choice, but actually it's a really hard job. But if you're up for that job, then go for it.
I'm curious, Stuart, from your perspective, do you find that there are a lot of people, or have you come across people where they have put together a concept or a pitch on the platform and not been able to deliver on that, or there is just nothing tangible beyond the initial concept? There's no proof of concept, for example.
Most of our businesses are up and doing something. Most are revenue generating. The point I wanted to add from the earlier conversation is an awful lot of these are people who've been experienced in business, lots of different businesses over decades before they, come and set up their latest business or even their first business. But yeah, sometimes your assumptions are wrong and the business can't succeed. I think as long as you explain that to people, one, people understand the risks when you go in. Two, you keep them up to date and you explain that you tried A, B, and C and pivoted in these three directions and still all your efforts have come to naught, then best just pack up and go home and go and try and do something else.
And I'm curious from your perspective, just generalistically, each of you, what do you think is going to be the most significant change that you think will happen in the industry or in your industry in the next kind of 5 years or 10 years, be that a technological change or a cultural shift that is going to change the face of your industry? And I'm going to throw that question first of all at David, because you've had the most time to prepare for the question.
Well, thank you. It depends. Just to make a point, it depends which industry you're talking about, because in a way I work in the venture capital finance industry, but also in the creative industries. So I'll take a view really from the creative industry. And I think the future is very rosy for the UK creative industry or creative industry companies. Technological change has always driven content. There wouldn't have been a music industry without technology called 38s and 45s and cassettes and CDs. So it is always a technology industry, and the technology that creates, monetizes and distributes that content is evolving very rapidly. I think some of the trends like curation, personalization, are going to drive increasing growth, increasing new sources of revenue, but going to be massive change because of think about how we all consume content media today, how it's changed in the last 10 years, and that will only continue. But we believe that what people want to do is consume the content, and therefore the value will continue to be in the content rather than in the distribution of that necessarily. Okay,
so you're still a firm believer in the content?
Yeah, you watch TV, don't you? You don't watch ITV or you don't watch your Sony. You don't sit down for your Sony tonight. you sit down to watch Downton Abbey. So it's the content that drives consumption, and it's content that drives monetization, whether it's advertising, subscription, crowdfunding programs to get them made, whatever might be happening, or movies. It's all about creation of the content.
Okay. What about you, Edzia?
So I would say that the entrepreneurial ecosystem in the UK is growing. We really need amazing talent to join. And at the moment, that's actually changing. So more and more people are coming into this industry, which is what we need as the digital skills gap. All these businesses need people to work in them. And that is changing. It's becoming more and more mainstream to be a business that is entrepreneurial or founded by entrepreneurs. Small companies, small businesses are are increasing. And I think that the appetite and the culture in the UK to actually keep creating small businesses that drive innovation and change, especially within technology and software, is ever increasing. It's exciting times, and those that don't participate will be left behind. So we are operating in fintech, and one of the reasons why fintech is such a big topic at the moment is because the financial industry is going through a lot of change and systems are changing. But how do you make sure you keep the lights on and you also make sure you're using the best technology to do the core business? And I think that that's really important. So, yeah.
Wonderful. And Stuart, what about you?
I'll keep one regarding one of our portfolio companies, GamesGrabber. What GamesGrabber does is it allows gamers and vloggers to hold their favorite games and things they're interested in all in one place, which at one level allows brands to see what people are really keen about and maybe make them offers. And another, it gives you a view on how that type of people, if that data is anonymized, might respond to a certain product or offer.
Okay.
And then we had a board meeting about that yesterday, so I'll get to the point shortly, which they can do. They've done GamesGrabber, they can do BooksGrabber, they can do WineGrabber, et cetera, et cetera. And is the thrust of the company, should it be selling out each of these portals to one big brand, or should it almost be offering each of these for free in order to get that big data that it can then really use that big data to in an anonymized fashion to help properly sell on or influence people? So I think there's a lot of talk around big data and how it can be used, but it's do you go out with a business plan to raise more funding on the basis of, well, we're going to sell these for X to A, B, and C, and they're all interested? Or do you say, actually, this is all about scaling this massively in order to produce really valuable data at the end point, which is going to be worth many times more than just selling it out and parceling it off? So that's to get over.
Interesting. Okay. Well, guys, thank you very much for joining us on this digital jam session. One of the things that we like to do for our listeners is to provide them with a way to be able to follow you using your social media handle of choice, whatever that might be. So if you would like to tell us exactly what your social media handle of choice might be, we'll start with you, David.
Follow us at @edge_invest.
Wonderful. And Stuart?
I'm a bit of a dinosaur at these things, so you're best to get me on LinkedIn. Just on LinkedIn.
Okay, we'll make sure that we put that link in the podcast notes. And Adzia?
So you can get us on at Level39CW or Adiza_Tajani, and spelling is something that you'll be able to see online.
Because I'm terrible with your name. I'm sorry.
Don't worry. I'm used to it. Lifetime's worth. It means I'm remembered.
You certainly are remembered. And thank you once again for joining us on this Digital Jam session. And thank you for listening. If you enjoy this content, don't forget to subscribe and review. Thanks again for listening to this Digital Jam session. digitaljamsessions.com